Welcome to Mindspace Capital Focus. On this channel, we explore investing strategies, wealth building techniques, and practical financial wisdom from the world's top investors. Today, we will dive deep into Warren Buffett's secret behind compound interest, the principle that has helped him turn modest investments into extraordinary wealth over decades. If you are new here, make sure to subscribe and hit the bell so you never miss any of our insights into smart investing. Understanding Buffett's approach to compound interest. Warren Buffett, often regarded as the greatest investor of the modern era, has built his fortune largely through the power of compound interest. Unlike short-term trading or trying to predict market swings, Buffett's method is grounded in long-term wealth accumulation, patience, and disciplined reinvestment. At its core, compound interest is the process where your investment generates earnings, and those earnings themselves begin to generate additional earnings. This creates a snowball effect, where your money grows faster over time. Buffett often stresses that the most critical factor is time. The earlier you start investing, the greater the potential of your returns due to this compounding effect. For example, imagine investing $1,000 in a high-quality company at a 10% annual return. After the first year, your investment grows to $1,100. In the second year, you earn interest not just on the original $1,000, but also on the $100 earned in the first year. By the 10th year, your initial $1,000 has grown to nearly $2,593 without adding a single extra dollar, and over decades, the growth becomes exponential, far exceeding simple linear returns. Buffett emphasizes consistency over time. Small, regular investments consistently reinvested in solid companies often outperform risky bets or attempts to time the market. He believes that frequent trading reduces the potential of compounding because each transaction incurs costs, taxes, and emotional stress, all of which diminish overall returns. Another important aspect of Buffett's strategy is choosing the right type of investments. He focuses on businesses that are easy to understand, have strong fundamentals, and possess a durable competitive advantage, often referred to as an economic moat. By investing in companies with predictable earnings and sustainable growth, Buffett ensures that the reinvested earnings continue to generate reliable, long-term returns. Patience is key in his philosophy. Buffett often says that his favorite holding period is forever. This approach allows the magic of compounding to work uninterrupted. Even in times of market volatility or economic downturns, maintaining long-term positions in fundamentally strong companies ensures that your investments continue to grow steadily. Dividends also play a critical role. Buffett prefers companies that pay consistent dividends, as these payments, when reinvested, allow investors to harness compound interest on both the initial investment and the dividends themselves. Over time, reinvesting dividends can significantly amplify total returns, sometimes more than the appreciation of the stock itself. Buffett also highlights the psychological aspects of compounding. Emotional discipline is essential. Many investors panic during market declines or get overly excited during surges, leading to buying high and selling low. Buffett, however, remains rational and focused on the long-term potential, understanding that short-term fluctuations are irrelevant to the ultimate wealth-building goal. Lastly, he teaches the value of starting early and letting time work. For young investors, even modest amounts invested consistently can grow into substantial wealth due to the exponential nature of compounding. Buffett himself started investing in his teenage years, buying small stocks and reinvesting profits. By leveraging decades of reinvestment and consistent strategy, he turned relatively modest savings into billions. In summary, Buffett's compound interest strategy is built on 4 pillars: time, patience, reinvestment, and emotional discipline. It's not about trying to predict the market or chasing quick profits. It's about letting your money work for you and giving it enough time to grow through steady compounding. Understanding and applying this principle can transform an ordinary investor into a disciplined wealth builder over time. The full power of Buffett's compound interest strategy. Warren Buffett's approach to investing is not just about buying stocks, it's about understanding the true mechanics of money growth over time. He emphasizes that compound interest is one of the most powerful forces in finance, a principle that can turn small, disciplined investments into monumental wealth over decades. At the heart of Buffett's strategy is time. Time is not merely a passive factor, it multiplies the effects of every decision. Buffett often illustrates this principle by comparing investments over long durations. A $1,000 investment at 10% annual return may seem modest in the first few years, but after 20, 30, or 40 years, the difference between investing early and delaying even a few years becomes astronomical. This is because compounding grows exponentially, not linearly. Buffett's strategy starts with selecting the right companies. He looks for businesses with predictable earnings, durable competitive advantages, and strong management. By investing in such companies, he ensures that the profit generated by the company can be reinvested efficiently, creating a feedback loop where the company's growth fuels his investment growth. One of the most critical lessons Buffett teaches is reinvestment. He consistently reinvests the profits from his investments rather than withdrawing them. For individual investors, this can mean reinvesting dividends, capital gains, or interest earned. Each reinvestment increases the base upon which the next cycle of growth occurs. Over decades, this snowballing effect produces returns that far outpace initial contributions. Buffett also highlights the importance of patience and long-term thinking. Many investors fail to achieve compounding benefits because they react emotionally to market fluctuations. They sell in panic during downturns or chase hot stocks during booms, disrupting the natural compounding process. Buffett, in contrast, holds quality investments for decades, sometimes never selling them. This patience allows the power of compounding to accumulate uninterrupted. Another key aspect of his philosophy is avoiding debt and excessive leverage. Buffett warns that borrowing to invest can amplify gains, but it can also amplify losses. When interest payments and market volatility combine, debt can destroy the compounding effect. By staying mostly debt-free, Buffett allows his investments to grow naturally, free from the drag of obligations or the risk of forced liquidation. Buffett also emphasizes the psychological side of compounding. Emotional control is critical. Fear and greed are enemies of long-term growth. Investors who panic and sell during market downturns lose not only principal but also the future compounding potential of their investments. Buffett's calm and disciplined mindset ensures that his money continues to grow steadily, even in turbulent times. Practical application for beginners. Buffett's principles are not only for billionaires, they are for anyone willing to start early and invest consistently. By investing in stable, dividend-paying companies and allowing the returns to reinvest automatically, even small amounts can grow substantially over decades. For instance, a teenager investing $50 a month in a reliable index fund could accumulate hundreds of thousands of dollars by middle age, purely through disciplined reinvestment and patience. Buffett also teaches that compounding works best when the investment is safe and predictable. Risky ventures with high potential returns may seem attractive, but the likelihood of loss interrupts the compounding process. Instead, he prefers businesses with a strong economic moat, consistent cash flows, and management that acts in shareholders' best interest. These attributes allow the compounding effect to work efficiently and predictably over time. Dividends are another crucial tool. Buffett often invests in companies that pay regular dividends, which can be reinvested to buy more shares. This creates a cycle where your money earns returns, those returns are reinvested, and the process continues. Over decades, dividend reinvestment can contribute more to total wealth than the increase in stock price itself. Buffett also emphasizes long-term vision over short-term gains. While many investors focus on quarterly results or market fluctuations, Buffett looks decades ahead. He reminds investors that true wealth is built slowly, silently, and steadily. Those who chase fast gains often miss the exponential benefits of compounding because they interrupt their investments prematurely. Finally, Buffett stresses the importance of starting now. Even modest investments, when started early, benefit enormously from the time factor. Waiting to invest or making inconsistent contributions drastically reduces the power of compounding. By acting early and consistently, even small contributions can grow into extraordinary wealth, which is the essence of Buffett's approach. In summary, Buffett's compound interest strategy is built on several pillars. Time. The longer your money is invested, the greater the compounding effect. Reinvestment. Profits, dividends, and gains should be continuously reinvested. Patience. Holding investments for decades allows exponential growth. Emotional discipline. Avoid fear and greed to protect the compounding process. Quality investments. Companies with strong fundamentals ensure predictable returns. Starting early. Time magnifies every decision, begin as soon as possible. Applying these principles consistently, regardless of market conditions, is what differentiates Buffett from most investors. His method is simple in concept but profound in effect. Let your money work for you over time, and the compounding engine will turn small investments into substantial wealth. Mastering Buffett's compound interest. advanced insights. Warren Buffett's philosophy on compound interest is not merely about letting money grow, it's a holistic investment mindset that combines psychology, discipline, business analysis, and patience into one seamless strategy. To truly understand why Buffett's approach works, we need to examine every dimension of his process and see how he applies it consistently over decades. At its core, Buffett treats investing like owning part of a business. When you invest in a company, you are not merely buying a stock, you are buying a share of its future cash flows. By focusing on high-quality companies with durable competitive advantages, Buffett ensures that the cash generated by the business can be reinvested efficiently. These reinvested earnings compound year after year, accelerating wealth growth far beyond the initial investment. Buffett also emphasizes the snowball effect of early and consistent investing. Time is perhaps the single most important factor in compounding. A $1,000 investment at age 20, growing at 10% annually, will be worth far more by age 60 than a $10,000 investment starting at age 40. The earlier one starts, the more cycles of compounding occur, producing exponential growth. This principle is why Buffett constantly advocates for starting early and contributing regularly, even if the amounts seem modest. Another vital aspect of his method is avoiding unnecessary trading. Buffett discourages frequent buying and selling because each transaction can incur costs, taxes, and market timing errors. Every time an investor sells prematurely, they interrupt the compounding process. Buffett's philosophy: buy solid companies and let them grow, allowing time to multiply returns naturally. Dividend reinvestment plays a crucial role in Buffett's strategy. By investing in companies that pay regular dividends, and reinvesting those dividends to purchase more shares, investors can dramatically increase their total returns over decades. This reinvestment cycle magnifies the compounding effect, creating a feedback loop where earnings generate more earnings. Over long periods, the value generated by dividend reinvestment often surpasses the growth in the stock's price itself. Buffett also focuses heavily on risk management, which is directly tied to compounding. Compound interest works best when the principal is preserved. High-risk investments may offer large potential returns, but they also threaten the capital needed for compounding. Buffett avoids unnecessary risk, selecting businesses that are predictable, resilient, and have strong economic moats. By minimizing the chances of permanent loss, he allows his money to compound reliably over time. Psychology and discipline are central to the process. Buffett consistently warns against emotional investing. Fear, greed, panic, and impatience are enemies of compounding. Market downturns are not threats to a disciplined investor, they are opportunities to buy more shares at a discount. By controlling emotions and maintaining a long-term perspective, Buffett ensures that his investments continue to grow uninterrupted, harnessing the full power of compounding. Buffett also teaches that simplicity is key. One does not need to invest in dozens of complicated assets or speculate on short-term trends. Instead, by understanding a few quality businesses thoroughly and holding them for decades, investors can achieve far greater wealth than chasing hot tips or trying to time the market. Buffett calls this approach investing within your circle of competence, emphasizing that deep understanding reduces mistakes and enhances the compounding effect. Real-world applications. For beginners, this means focusing on stable, long-term investments and avoiding frequent portfolio changes. Even a small monthly contribution, consistently invested in high-quality stocks or index funds, can grow tremendously over decades. For example, contributing $200 per month to a solid investment that grows 10% annually for 30 years could result in a portfolio exceeding $300,000. This demonstrates the power of consistency and compounding combined. Buffett also stresses the role of patience in ignoring market noise. The world is filled with daily headlines, market volatility, and economic predictions, which can distract investors and prompt impulsive actions. Buffett advises focusing on the fundamentals of the businesses you own, not daily price movements. By ignoring short-term noise, investors let compounding do its work uninterrupted. Moreover, Buffett integrates tax efficiency into compounding. Taxes on dividends or capital gains can erode returns, slowing growth. By holding investments long-term and reinvesting profits before taxes, the compounding engine works faster, and wealth accumulates more efficiently. Finally, Buffett emphasizes the multiplier effect of knowledge. Compounding is not limited to money, it applies to skills, experience, and decision-making. Learning continuously about businesses, industries, and market psychology increases the investor's capacity to make high-quality decisions. Each well-informed decision contributes to better investment outcomes, which then compound in financial terms over the years. In essence, Buffett's compound interest strategy is multidimensional. It combines time, patience, disciplined reinvestment, risk management, psychological control, knowledge, and quality selection. This combination allows him to turn modest beginnings into extraordinary wealth, proving that consistent, intelligent investing is far more powerful than chasing quick profits. Buffett's compound interest in practice, turning strategy into real wealth. Now that we understand the philosophy behind Warren Buffett's approach to compound interest, it's time to explore how to apply these principles in real-world investing. This final part will provide practical guidance, illustrating how investors, beginners and seasoned alike, can harness the power of compounding to build lasting wealth. 1. Start early, stay consistent. Buffett's most repeated advice is to start investing as early as possible. Time is the single most critical factor in compounding. Even small amounts invested regularly can grow into extraordinary sums over decades. For example, an investor contributing $500 monthly at an annual return of 10% could accumulate over $1 million in 30 years. The key is consistency, making investing a routine, disciplined habit. 2. Focus on quality businesses. Buffett doesn't chase trends or short-term gains. Instead, he identifies companies with strong fundamentals, sustainable competitive advantages, and predictable earnings. By investing in such businesses and holding them long-term, compounding works its magic. The dividends and profits generated are reinvested, fueling exponential growth. Buffett's principle: it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. 3. Reinvest profits and dividends. Reinvestment is where compounding truly accelerates. Buffett consistently plows back earnings into his investments, whether by buying more shares of his favorite companies or reinvesting dividends. This cycle of growth-on-growth multiplies wealth far faster than simply relying on stock price appreciation. Over decades, the power of reinvested dividends often exceeds the gains from stock price increases alone. 4. Avoid emotional decisions. A key to Buffett's success is his discipline under market volatility. Stock markets are inherently unpredictable, with daily swings that can trigger panic selling or overenthusiastic buying. Buffett maintains a long-term perspective, ignoring short-term noise. His mantra: be fearful when others are greedy, and greedy when others are fearful. By remaining calm and patient, investors let their compounding strategy continue uninterrupted. 5. Minimize risk and preserve capital. Compounding works best when the principle is preserved. Buffett avoids high-risk gambles that could result in permanent loss of capital. By selecting companies that are resilient, economically strong, and less prone to catastrophic loss, he ensures that his investments can continue compounding reliably year after year. This principle is vital for all investors: protect your initial capital to maximize long-term growth. 6. Understand the role of taxes. Taxes can significantly impact compounding. Buffett minimizes tax impact by holding investments long-term and reinvesting before selling. By avoiding short-term capital gains and letting assets grow inside accounts that defer taxation, investors preserve more of their returns. Smart tax planning enhances the compounding effect, ensuring more money remains working for the investor. 7. Patience is the ultimate tool. Perhaps the most overlooked aspect of compounding is time itself. Buffett's wealth grew not because of instant windfalls, but because he patiently allowed his investments to grow for decades. Long-term thinking, patience, and discipline combine to make the simple act of compounding extraordinarily powerful. 8. Continuous learning and knowledge compounds. Buffett's investment skills are also a form of compounding. By continuously studying businesses, markets, and financial principles, he increases his ability to make informed decisions. Each well-researched decision builds upon previous knowledge, multiplying returns over time. In other words, compounding isn't just about money, it's about skills, wisdom, and decision-making. 9. Practical takeaways for investors. Start investing early, even with modest amounts. Focus on high-quality, fundamentally strong companies. Reinvest profits and dividends consistently. Avoid emotional reactions to market swings. Preserve capital to protect the compounding engine. Plan for taxes to maximize growth. Be patient and allow time to work in your favor. Continuously improve your investment knowledge. By implementing these strategies, any investor can turn small, consistent efforts into extraordinary wealth over time. Buffett's compound interest strategy is not a shortcut, it is a disciplined, patient, and intelligent approach to growing wealth. Those who follow these principles understand that slow, steady, and thoughtful investing beats high-risk speculation every time. In conclusion, Warren Buffett's secret is not magic, it's a careful combination of knowledge, discipline, patience, and the relentless power of compounding. The sooner an investor embraces these habits, the sooner they can harness one of the most powerful forces in finance, compound interest working over decades.